The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Squawk Box. Here are your headlines today. A market whiplash. Japanese stocks rebound with the Nikkei set for its best day since 2008. While US futures also point to gains stateside. It comes after a wipeout on Wall Street with the Dow plunging 1,000 points for its worst day in almost 2 years, while the Fed's Austin Goolsbee attempts to calm markets.
The Fed's job is not to react backward looking to 1 month's numbers. And if you look at how the market reacts in its predictions of the Fed funds rate, there's a massively more volatility in the market reaction on a day-to-day basis.
Kamala Harris is officially the Democratic nominee for president as her shortlist for the VP pick reportedly narrows, with Tim Walz of Minnesota and Josh Shapiro of Pennsylvania the last two standing. Google is a monopolist. The tech giant loses a landmark antitrust case as a U.S. federal judge rules the firm has an illegal search monopoly.
Bounce back day, that is what we're setting up for today. We're seeing it across the Asian markets at this stage. But I would point out, on days after a huge rout, typically you can see a snapback. The big question we're going to be debating over the show is whether we're done yet, whether this is some calm restoring our markets, or whether we're just seeing another exit point for investors to get out of some exposures.
Exactly, and this is what I think the market was also asking itself yesterday. Was everything we saw actually just overdone? Was it an overreaction? I mean, we saw the VIX actually go up massively to that 64-point level as well, the 64-point mark, and everyone was just wondering, is that just a panic? Since 1990, the VIX hasn't closed above 50 points other than in 2008, 2009, and 2020. All right, so that kind of gives you a clear sense then of how dramatic that move up was. Well, perhaps just a panic in that market.
There's a couple of big themes playing out as well here. The carry trade, the using of the Japanese yen, a cheap currency, funding currency, pouring that money into other areas of the global equity markets, global asset classes. That's been unwound, and the view is that this cannot be simply unwound in a 24-hour period. That there could be more to come. Precisely. It's not a short-term window. So there is that feature we're debating. Also the consequences if we are talking about a recession stateside now, which was not the scenario we were talking about a couple of weeks ago, the soft landing being pushed aside. Does that mean we are looking at a genuine change in monetary policy? And again, we don't really have the answers for that. We're not going to have it until more data is forthcoming. So again, it feels like we're not going to cross that hurdle just yet. Meantime, let me just show you those Asian equities. They are rallying after yesterday's massive rout, which saw Japan's benchmark Nikkei index post a bigger points loss than on Black Monday almost 40 years ago. The dollar is regaining some ground against the yen after the Japanese currency surged as much as 2.5% against the greenback Monday. The Bank of Japan will meet with officials from the Ministry of Finance and Financial Services Agency today, 8 CET, with the press conference due to follow. Lynn has the latest from Singapore. Lynn, just walk us through the bounce back we're seeing and what's taking place in the backdrop to ensure that these markets are functioning smoothly.
Hey, Karen, as you've said there, we've seen this big bounce back in terms of the Japanese equities. We are off our session highs, but still, you've got the Nikkei 225 up about 7.3% off the back of that big sell-off, although we are still well off those record highs that we reached only in July. We saw the Nikkei 225 at around those 42,000 levels. In terms of the sector breakdown, we're seeing increases across all of the sectors. You have the energy, real estate, as well as basic material sectors doing the best. But in terms of all of those heavyweight stocks, the exporters, the auto stocks and the tech stocks, they are all bouncing back today. For example, there you've got Toyota Motor was down 14% yesterday, bouncing back by 9%. Hitachi also up by about 13%. Also, if you look at SoftBank Group, for example, falling falling by 19% yesterday, the biggest daily fall since it was listed. Also seeing a bounce back there. Also other chip-related plays. But as you were highlighting in terms of, the key question here, does this rally that we're seeing, this bounce back, does it have legs or is it a dead cat bounce? We've been asking a number of analysts during Asia's session about this. Certainly there is this view that what we saw yesterday in the markets and on Friday, it was overdone, that it doesn't reflect the fundamentals. We spoke, for example, with an analyst from UBP. His view is that the fundamental story in terms of Japanese equities, in terms of the corporate governance, in terms of the improvements to price to book, that is still intact. And with the yen appreciating, that there could be opportunities, he says, in relation to a lot of these domestic-facing stocks. But on the other hand, other analysts have said in terms of that massive yen carry trade, that funding trade, yes, that's been unwound. We've seen that hot money leave. However, there could be still so much more to go, and today could be more of a breather. Now, in terms of the other things we are tracking as well, it is the data from Japan in terms of real wages as well as consumption. So some key data coming through that showed some good signs and some not so good signs. But in terms of the good signs, the real wages, it grew for the first time in 27 months. It was up 1.1% on an annualized basis for the month of June. However, and this was really one of the concerns heading into the BOJ meeting, in terms of the household spending, that is still declining. It fell by 1.4% year on year, and it missed expectations, guys.
Lynn, thank you very much for bringing us the latest out of the Asian markets. Just going to recap all that action stateside. It was this huge move that we saw on the Dow, stripped of 1,000 plus points, 2.6% in the red. And we saw on most of the major markets the worst trading session since mid-September 2022. Some of the big moves to the downside, well, these were the moves to the upside previously. United Health, that was leading the Dow lower. We saw on the likes of the S&P 500, also on the NASDAQ, NVIDIA, but also negative news flow coming out on the production levels that NVIDIA might be hoping to achieve this year, and in terms of the supply chain challenges it's facing with one of its major partners. So that was the big stock moving to the downside, away from the broader themes that you were seeing, where tech was hit very aggressively. There's a little bit of M&A in the mix that helped out some names, but by and large, it was a complete rout we saw stateside. And typically this is baby out with the bathwater type of trade that happened yesterday as these markets opened up for trade. In terms of the best and worst performers, let's just take a look, and you can see those major plays to the upside. You can see not much to write home about in terms of better performers still in the red. The likes of 3M, Procter & Gamble, Caterpillar, Walmart, these were the better trades, but the worst trades you could see, Amazon down 4%, Cisco, Apple and Intel rounding out some of the weaker performers, and Intel of course picking up on what was already a dire performance a week prior. To the big tech names, this is a look at those big players in the tech universe, where, don't forget, we were talking about the carry trade yesterday, where money had been moved out of the Japanese market into some of the big tech players, and these were the natural homes for many investors, and globally there's been an enormous amount of herding into these names. So NVIDIA down more than 6%. Other major names you could see also in reverse, between 2 and 4% roughly, coming off these big tech stocks. Well, the VIX, this is of course the so-called fear gauge. The VIX surged even before the US opening bell, rallying more than 120% at its highest. So we really had levels in session that was the highest level since March 2020, which of course was that COVID era trade. As we take a look at the VIX today, we're 38.57, well and truly off those teens, the level that we were trading at for a long time, where there'd been barely any fluctuation on the markets. To treasuries, many are looking ahead to the bond markets and saying this could be the area where we're looking for some stability. And if the bond market stabilizes, well, it may be a precursor to the equity market stabilizing. Where we are perched this morning, you can see the long end trading lower than the short end, with 3.83 on that 10-year, and we're just shy of 4% at the short end on the 2-year, 3.95%. To the dollar trade as a result, and don't forget, it's been a very tricky equation as those markets have been selling off, to look at the dollar as a safe haven when Karen, yields have also been slumping, and there's a question as to whether we're now talking about a 50 basis point move lower by the Fed. A sterling dollar cable, it is 127.72. Cable on the back foot slightly this morning. Euro dollar, we're 109.50. Dollar yen rates this morning, clearly the one we're watching. It's been a bounce back for the dollar again. Further strength here, 145.22. So yen is taking somewhat of a breather in this session. Arabile.
Yeah, well, Karen, we just heard Lynn talk about a dead cat bounce, right? And is that really what you're going to see in this market picture? Well, that seems to be the case if one is to look at the U.S. futures, right? So some prodigious turning around of the picture overall is what could be in play here. We saw the S&P 500 futures then bounce in that overnight trade, notching yesterday, of course, their worst day in nearly 2 years as global markets sold off then. So you're seeing that perhaps come back just a little bit. Even some of the major tech names, in fact, all of them have all rebounded, one in after hours trade as well. And that's where you're seeing it. Significant gains there. Nvidia more than 3% higher in that after hours trading move. So perhaps a rebound of sorts. But does that mean that's the end pretty much of that downturn? I mean, the market is pretty much primed for this, saying that valuations were just too high. So how much of this uptick are we going to continue to see?
Let's get to Matt Orton, who is Chief Market Strategist of Raymond James Investment Management. Matt, we're still contending with two big themes here, the carry trade, whether this is still yet to unwind and whether there could be further exits taking place. And the other big one is whether the US is going into recession. As you weigh up those two major themes for markets, how are you thinking about the rout that we experienced yesterday?
Hey, good morning, Karen. Always good to see you. And certainly this turnaround Tuesday is encouraging. I think it was expected given how washed out market conditions became. And the question is exactly as you said it. Is this going to continue going forward? How sustainable is this rally? I think medium, longer term, we're going to see a turnaround in the market. But in the short term, I do think there's still going to be a period of indigestion because at the end of the day, there's been a tremendous amount of technical damage that has been done to just about every single chart across global markets and across all asset classes. That's going to take time to heal. The damage to investor sentiment is going to take time to heal. A big part of this is because investor positioning was really caught offsides. But at the end of the day, I believe the fundamental picture remains in place. I do not think the U.S. economy is moving to recession. The ISM services data we got this morning, I think, continues to corroborate that. We're going to get initial jobless claims on Thursday, retail sales next week. So what I encourage our clients to do is get your shopping lists ready for the damage that's been done and continue to build balance in portfolios and leverage this as an opportunity to set your portfolios up well going forward for what kind of a mid-cycle rally, a continuation of that rally is going to play out to be.
Matt, getting in line for a lot of investors is what the Fed's going to do from here, because that could have fairly significant consequences for funding. In terms of the 50 basis points that is now being discussed by markets as to whether the move by the Fed could come in September to that extent, do you think we are talking about emergency moves by the Fed?
You know, Karen, I do not think we're going to see emergency moves by the Fed because that would signal something very pernicious lurking beneath the surface that a lot of investors don't see. I believe that this trade's gotten ahead of itself with respect to 50 basis points emergency cuts because, again, the fundamental picture is just not that dire. I think we've gotten confirmation that the economy is slowing. I don't think it's cracking. You know, when you look at corporate earnings season, earnings have come in strong. And to me, what's really, really important is that corporate management teams have been signaling strength going forward. We've actually been seeing really strong guidance across a number of different sectors, not just from tech, but from cyclical parts of the market too. So that to me doesn't signal that we're heading into a deep, dark recession. And the Fed, in order to really completely change its playbook after setting the table for just a September rate cut of 25 basis points, the whole summary of economic projections is going to have to vastly change. And I just think that sends a very dangerous signal to the market. So I really don't see that playing out. And again, that's why I think investors can start to dip their toes into the market, or at least start to pick the parts of the market, high quality investments that make a lot of sense for their portfolios that have been just taken to the woodshed over the past week of trading.
Yeah, Matt, good morning to you. I mean, we know the very famous quote then by Alan Greenspan, who had made note of how, he's continuously still willing to support the market and really didn't have to do anything other than offer those words. This is a time when perhaps Jay Powell needs to try and offer those sort of words as well to this market picture, just to let it all be known that the support is still there, but of course, he'll let things continue to flow as they are.
That's a really good point, Arabil. I think Powell would do well, especially when we come to Jackson Hole, to really signal that a September cut is in fact coming. I think he can go further than what he did at the July meeting. He can be more direct. I think some of the Fed speak that we're going to get over the coming weeks is probably going to do just that. And reminding the market that the Fed has a lot of, call it dry powder. It can really step in and help the economy if necessary by taking more drastic measures if that happens to be what we need. Again, I don't think it is, but by signaling that, I think that can have a strong impact as well on at least repairing investor sentiment and giving investors more confidence that, yes, this is a market in which that I can feel confident investing in, and that if we do happen to move into a recession, there is essentially a put in place from the Federal Reserve. I still don't think that necessarily changes the ability to step into the market, maybe not at this point, but as the dust starts to settle, because a lot of really compelling investment opportunities have been created over the past week or so. Dividend growers, high quality investments, even in financials, where there's just been a lot of damage, but very solid fundamental pictures.
Yeah, so Matt, are you expecting a bumpy ride higher for the remainder of the year market-wise?
I think it's going to be a bumpy ride over the next month or so, call it through Jackson Hole, when hopefully we get another clear signal about rate cuts, and hopefully the marginal economic data we get over the next couple of weeks continues to corroborate just a slowing economy, which we all knew, but not one that's rapidly deteriorating. If that plays out, I think the bumps will turn into a stronger path going forward. The big question mark again, though, is U.S. elections. We are heading into an election season, which is why, again, I think you want to be very careful about building a balanced portfolio, not just rushing into higher beta, higher duration plays, but just making sure that you're really focused on quality within the portfolio, because I wouldn't be surprised if we do go through another bout of volatility in October. That's been the pain point over the past 2 years. I'm not sure it's going to be any different this year as we head into elections, but on the flip side of elections, historically, you tend to see market strength. And I think that added clarity we'll get no matter what side wins, I think that can give markets more confidence too, especially given the earnings picture has remained very constructive.
Matt, we're always one event away from another event risk, it seems, in this market. But thank you so much for joining us then here today. Matt Orton is the Chief Market Strategist then at Raymond James Investment Management. We'll be discussing these moves and a whole lot more then, especially with former ECB President Jean-Claude Trichet. He'll be joining us then at 9:30 CET. Do stay tuned for that interview live here on Squawk Box Europe. Also coming up on the show, we'll dig deeper into Japan's market rebound with the Nikkei on track for another historic session, this time on the other side of that. Plus, earnings on the way from the world's second largest company. Look at what to expect from Aramco. And we'll have a check on the recruitment sectors. Adecco reports CFO Karen Williams, who joins us right after this break.
Listen to CNBC's Beyond the Valley, the podcast that explores the biggest tech news from across the globe. Join me, Arjun Karpal.
And me, Tom Chitty, every week as we bring you insights into the top stories, unpack the latest trends, and find out where the industry is headed.
Now available on Spotify, Apple Music, and Google Podcasts.
Welcome back. Now, the Adecco Group reported net income of 58 million euros in the second quarter. That's down 2% on the year, narrowly missing estimates amid what the recruitment firm described as a challenging market. The company said it sees some margin improvement in the third quarter as it focuses on cutting costs. Karim Williams is the CFO at the Adecco Group and joins us now. Karim, thank you so much for the time then. Outperforming some of your peers still in this tough market, it certainly isn't one where you can just, I suppose, not have this cost management cycle in place. How long does it stay in for?
I think it's really important to just pick up on your point about outperforming peers, because we do feel that we've had a good quarter in Q2. We've taken share for the 8th consecutive quarter. The strategy is working. Our relative revenue growth is 375 basis points higher than our peers. To your point, we're also being very disciplined in terms of the way that we manage cost. We've had a G&A reduction program going for a number of quarters, and we've over-exceeded the targets in terms of what we've delivered. So 162 million of run rate savings versus 150 million. And then on top of that, which is translating through to a robust EBITA margin, we've also delivered more cash, both in terms of operating cash flow and free cash flow. So for us, it's been a strong quarter. I think in terms of your question of how long does it last, it's not just about cost. We're obviously pleased with where we've got to on the cost management program, but we're also very, very focused on taking share where opportunities exist, and we're determined to keep that going.
So how do you get those opportunities? What exactly are you looking for in that pace? Is that by way of acquisition? Is that by way of assimilation into different areas and different growth models as well? What exactly are you looking at?
We've got a really broad-based portfolio. So we deliver flexible labor services, we deliver professional recruitment, we have an engineering R&D consulting business, and that gives us a breadth to what we offer. But equally, we're very diversified within those individual GBUs. So we can really point at the sectors and the territories where we see growth. And that's what we've been doing for the last 8 quarters. It's why we continue to deliver share gains against our peers.
Karim, it's Karen jumping in. We've got a market route that's been playing out over the past number of sessions. And one of the reasons has been the US jobs market. There are concerns about what that's signaling. As you look at the job market from your lens, is there any significant cooling that has stepped up since the last quarter when we spoke to you?
I don't think there's been any significant cooling since the last quarter. Obviously, the data that we saw last week was not where people were expecting it to be. But to be fair, and we've spoken about this before, Karen, the US labour market is quite mixed. There are pockets of growth and there are areas of pressure. And for all of the recruitment players, whether it's professional recruitment or flexible labour, this has been a challenging market for a number of quarters. So it's less that there's been a big shift. It's more that actually there's been quite a lot of pressure in that market for a period of time. For us, we are very, very focused on positioning our US business in a way that makes sure it is as healthy as it can be. Been working on sales intensity, been working on the cost base, and we're really making sure that we are positioned well to capture growth and take share when that rebound comes, which it will do.
Karim, the market is looking at jobs report still, the 114,000 jobs created and the unemployment rate ramping up. And they're saying, is this just a one-off? In your view, was it just a one-off as you look at some of the dynamics that you're witnessing?
As I said, I think this is more of a continuation of a trend that we've seen for a number of quarters and that has impacted particularly our industry for a period of time. There isn't anything structural happening. I think there is simply macroeconomic concern, which leads to a slightly subdued job market, but ultimately that will pick back up, and we are really well positioned to benefit from that and take share when it does.
We're closely monitoring the numbers, and thank you very much for telling it through your lens today. Karim Williams with us, the CFO of the Adecco Group. Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to CNBC.com.
Or join us again on the show with Steve Sedgwick.
Karen Cho, and myself, Arabile Kumete, weekdays on CNBC.